Welcome to the MarketEdge Tech Talk with Will Paule and special guest David Blake. We're going to review the market conditions of the past week as well as longer-term trends from a technical perspective, take a closer look at the major indices, and to wrap it up, dig into a handful of individual stocks and ETFs requested by subscribers. If you have questions or want to submit a stock for next week's webinar, email us at support@marketedge.com.
Hello and welcome to the Tech Talk for Tuesday, December 20th, 2022. I'm your host, Will Paule, and I'm here with my co-host, David Blake. How are we doing today, David?
Doing good, Will.
All right, let's start off with a look at what the market's been doing this past week with a look at the market letter.
All right, we had another volatile week. We started out like gangbusters as investors kind of hoped that cooler inflation was going to, maybe have the Federal Reserve, pause a little bit, might force their hand and have them back off its aggressive tightening policy. But as you know, we had the FOMC meeting last week, and on Wednesday, we raised it a half a point as expected. But then the committee kind of threw the investors off a little bit when they raised. They lifted the federal funds rate up to 5.1%, but that kind of caught investors a little bit off guard. So equities tumbled on that. They had been up. I think we had about a 1,200 point gains in the Dow just on Monday and Tuesday. After we had that CPI come out below expectations and stuff, and then Tuesday afternoon they kind of faded a rally. I think we were up like 400 or 500 points. They kind of faded that a little bit, brought it back in. And Wednesday we started to, we rallied again a little bit. And then when Powell came out and was a little bit more hawkish than what the market wanted, we kind of erased that, and then we tumbled into the weekend. Pretty much, energy still outperformed a little bit. It eked out a little bit of a gain, but the rest of the sectors were all weak. Again, on a slowing economy, the growth sectors are the worst performers, and of course, consumer discretionary, communication services, technology, and financials and materials were the worst sectors in there. We had yields finish a little bit lower, surprisingly, just because of recession fears. Even though they're talking rates up, the market's telling you, and the bonds are telling you that you're not going to be up there too long because we're going to be going into a recession. So that brought the 10-year T-bill back below 350. It was at 349, I think, is where it went into the weekend. 2-year rate was right around 421. We ended up with the major averages down for a second week. That's only the second time, or the first time that the major averages have had a 2-week losing streak since going all the way back into September. So, it wasn't terrible, but all in all, we lost. The Dow was down about 1.7%. NASDAQ was down about 2.7%. A lot of that was selling in the big cap technology stocks. I know Meta got slammed. Tesla weighed on the consumer discretionary sector. I know it's down something like 40% over the last month or two. So a lot of the big cap companies are just they're weighted on the NASDAQ and some of the indexes, and that's really it's because they're kind of swinging to the downside a little bit more than normal here. We have the small cap Russell 2000 was down about 1.9%, and it's basically we just saw more deterioration in the technical condition of the market. How about going to the market recap on the home page here, Will? We'll take a look at some of the things that we look at. Now, while he's getting to that, we had most of the indicators fell back into the into the bearish camp. Momentum is measured by the 14-day RSI. That's split in the negative ground. Of all the indexes, we now have the Dow Jones above the 200-day moving average. That's the only one, but it did slip below a descending trend line, which we've talked about going from January to October. That was actually a big plus because a lot of times when you have a long-term trend line that the indexes bounce off of, several times, 3 or 4 times, when it finally breaks above that, it's noticed by the algorithms and by technicians, and it generally they'll call for a change in the overall trend. But unfortunately, Friday and Monday, the Dow wasn't able to hold that. So we slipped below that trend line, and that was a negative for the broader market. We also slipped back below the August high. We talk often about the markets in making higher or lower highs and lower lows, which is a bearish condition. And the Dow Jones was actually the first one that had broken that trend also, where it had gone above the August highs, but it was unable to hold that. Okay, we have the S&P 500 now trading below its 200, 150-day moving average. So was the NASDAQ. As you can see in here, let's see, the secondary indexes that we look for the market to kind of lead, they also had a bad week. We had the Dow Jones Transportation Index tried to hold the 50-day moving average. I think it was sitting right on it, on that 50-day moving average there. You can see the chart there on the left. And then I think yesterday it broke below that. The Russell 2000 small cap, it dropped below its 50-day moving average. It was actually above its 200-day moving average. You can see that right next to the S&P 500 there. So that's another negative for the broader market. Probably looks like we're going to end up, even if we get a little bounce in here like we're getting today, January doesn't look too good at this stage. As far as the underlying breadth goes, we can look here on these two charts. You see the NYSE advanced decline line and NASDAQ advanced decline line, both losing ground here. They're heading back. The NASDAQ actually is now below where it was as far as accumulation numbers go, at where it was back in October before we started to bounce. As you can see there, that sideways motion there with the NASDAQ. Despite the fact that we had about a 12 or 14% bounce there, it wasn't confirmed by the AD line, and generally you want to see that supporting a move on the advances. Now you can see the NYSE advanced decline line rolling over, and we look at that as a leading indicator. That neither one of those lines look like they're going in the right direction. You can also see down at the very bottom the new highs versus new lows. We're seeing that starting to expand, especially on the NASDAQ again. Interesting note, most of this is going to be on the NASDAQ. I know that we read today where 25% of the IPOs and the SPACs that came out in 20 or 21 are in danger of being delisted by the exchanges. And when that happens, whether they go down, they fall below $1 or something like that, or just the fundamentals, the sheets aren't, just the financial sheets just aren't capable of supporting a listed stock again. I've never heard of that. I've been in the market since 1985, 86. And I've never seen that high of a percentage of stocks just completely falling out of bed if the market can't support them. So that's another sign that this isn't a healthy market in here at this stage. So anyway, then we also have the sentiment indicators. It's kind of neutral. We did see it's kind of a mixed picture. We saw that the retail investors remain fairly bearish. I think, let's see, the American Association of Individual Investors have them down here. They've been going down to around 27% of retail investors are bullish. That's it. Generally, that's going to be around 37%. And then if you look at the weekly percentage of bears and bulls, the bulls have actually outnumbered the bears for about 4 weeks in a row. So you have the pros trying to buy up. They're getting a little bit more bullish in here, but I don't think they're going to be right. It just doesn't seem to be. Now the hedge funds actually, we saw about a 10% tick down. They went from 60 or 55. No, actually it ticked up. I'm sorry. They went from 55% exposure 2 weeks ago to 71% exposure last week. So that's the pros are getting a little bit more bullish. Now whether that is due to some portfolio management here at the end of the year or not. I mentioned yesterday in the daily comment that not only are we seeing people dumping some of these big caps that they had losses for in the end of the year, you're also going to have portfolio managers begin to shuffle their holdings around. They don't want to be sitting here end of the year statements go out, and all they have in their account is Meta and Microsoft and Apple and Google and all these stocks that are down 40-50%. They want to at least appear that they were a little bit better investors than that, and they're going to kind of beef up their holdings page. And also, you might have some selling in some of the stocks. I just bought some of things like Raytheon, Pfizer, some of the drug stocks here over the last say 3-4 months. You're up 15 to 20%. You may just want to, if you think we're going to have a bad market in January again, you may want to, you're having some people, I think, take some profits and raise some cash. So if we make the next bottom, maybe they'll have some funds that they can pick up some of these stocks that are just, down 70, 75%, something like that. So I don't see, the market having a big, strong rally here right now. But as far as the technical condition goes, we deteriorated last week, and we actually broke through some secondary support levels that I think are going to cause the market some more trouble going forward.
All right. So what are we looking for during this week? Or what do you see going forward this week? Do you think a Santa Claus rally is still in the cards, or is he going to be a no-show?
Well, let's go ahead and pull up the Dow Jones. We're going to take a look at that first. Go ahead and go to the charts. And we'll go back. We're going to take this back about a year. And the first thing I want you to do is I want you to take the trend line up there and draw it from the left side there. I just, going to go back. So I go back to January of 2022. It's fine. Okay, that'll be fine right there. And you can draw there from the January, draw the trend line down through the January top, down through the August high. And you're going to touch that and then touch the August high, take it to the end of the page. Okay, there you can see right now, take it up a little bit higher. A little bit higher. Well, yeah, there you go. You can see right here that trend line's kind of falling into place right about where the 50-day moving average on the is coming into place. It's also right about where the 200-day moving average. And so this represents a big support area right now for the Dow. A break below this is not going to be good in general at all. A lot of times when you have several moving averages or even a trend line come into play all around the same area, the more indicators that come into play at one spot or at one level, the stronger that support or resistance is going to be. In this case, we really need the Dow Jones to hold this area. I'm not so sure it's going to. That we have the 14-day RSI now ticking down here at 42. Again, remember, if that breaks below 40, that's a syndication that we're probably going lower. Stochastics, the ones that I look at, the 30-day stochastics, are down here around 22 to 30. I would say that's that means we can probably still get a little bit more selling before we actually even oversold. So I would say watch this area right in here around the 32 245 area, 32 450. We need to hold that if we're going to say. I don't think it's going to, but if perhaps because it's the last week of the year here, so the next 2 weeks, we could see a little bit of if Santa's going to show up. We need to hold this and bounce off of this area right here. We'll have to see if it happens. And then on the upside, that trend line comes back into place somewhere right around, can't really see it on there. If we can get back above, say, 33, 33.4, so 33.3, that would be a positive for the market. But I think at that stage, you're going to see the market roll over again. Let's go ahead and look at the S&P 500. Well, let's draw that trend line in again. And this time you can see that as you draw that trend line in, it's going to top out right here where we just were. As you can see, we got down here and it bounced off of here twice in December and November, tried to get through that descending trend line and just could not get it. And so it's no accident that that's where we had the resistance. So that would basically kick off some of the algorithms that would kind of indicate that we're having a change in trend, and it just could not go through there. Now, another thing that you can look at that is if we have if you drew in did the Fibonacci's from the August high down to the October lows on the S&P 500, what you would see was that we got up there. That trend line comes in right around, looks like the 62.8% retracement level, somewhere around in there. And that's our Fibonacci resistance level also, where that trend line came in. So it kind of got a little bit of a double whammy. And now we're coming back down where we basically retraced 50% of that whole move off of, from the August down to October. We were trying to get back up to the August high. We could not do it. And now from what we've bounced off of, and here in October up to December, we've already retraced 50% of the move there. Going back to there, I know we're actually trying to bounce off that, let's see, 62.8% retracement on that. So that's, again, we need to hold that. We could get a little bit of a bounce in here because of the Santa rally, but, again, the MACD is negative. 14-day RSI is down here right at 40. When we see that break down at around 36 or 35, that's usually an indication that we're going to be going much lower. That's kind of a trend change. And then if we pull up the NASDAQ real quick, you can do the same thing here. You actually just need to draw in from the April to the August high. And, we never even got close to the downward descending trend line on the NASDAQ. As you can see, we're still way off of that. In fact, from the August to the October high, we actually, these two bumps over here on the left, that was about 50% retracement of that move down lower. We got close to that. We couldn't even break through that. We got up near the 100-day moving average, couldn't break through that. And, these are all just negatives. There's just too much resistance that we couldn't even break after a year's time in there. And that's just more signs that we're probably drifting lower. I would expect to see the NASDAQ, it would surprise me to go down here and maybe down here around 10,250, I think is what we had, as I said last week, would be the bottom of its trading range here from the bottom of October back into where we are right now. That's a pretty narrow range in there. So 10,250 to 11,5. We're not down to the 10,250 yet. I would expect to see we could see maybe a little bit of a bounce in that area. If we don't get through that, we're probably going down. Look at the October low. We'll see about that. But that trading range from 10,250 to 11,5 has been in place for a while. I expect to see that come down to 10,250. Again, the stochastics are still in the 20s and 30s on this thing, so it can still go lower. The 14-day RSI, however, is at 38 on this. And again, when we break below 40, that's a little bit of a problem. Well, go ahead. One last thing I want to bring up real quick that you want to watch this week, and that's TNX. This is kind of an ETF. It's basically, this is kind of like the 10-year yield. And we got today, we're up to around, we kind of, if you go back here to the August lows and take the Fibonacci up to the recent high there in October, you can see we retraced, we've pulled back about 50% of that. We retraced about 50% of that move. There you go. Take that up to there. That's good. And what I see right now, today I think we broke above, let's look at this, we broke above 3.7, which was, I think that was, I can't really see what that is. That might be that we'll come back to 31. I can't see it, 38.2%. But anyway, it looks like we're at around 3.7% on the yield on this thing again. So we're moving higher. Today we had the Bank of Japan raise rates a little bit. They've held off forever, and the fact that they're they were the last holdout as far as raising rates. I think you're going to see this TNX and the yields of the 10-year. I think we'll probably see over the short term that hit around 385. I hope that's about where it peaks out. I don't want to see the 10-year get up into the fours, or we could really have a hard rollover here. But I think as long as it's ticking up here around 385, that would be still going to cause some problems for the market going forward. And I think you want to watch that. I mean, if we can get some bad economic news right now, unfortunately, for the last couple of months I've been saying that bad news is good news. In fact, that it might slow down the Fed, but now it's kind of at the point where bad news is going to be bad news, and it just means the worse the economic data is, just means the deeper of a recession we're probably going to fall into, despite the raising rates. Now, a lot of people that haven't gone through a rate rising cycle, it takes 6 months for these rate hikes to get into the economy and really slow things down. We've got a ways to go. We're just starting to get into it here in January, where we're going to start to see the real effect of when you raise rates 3% and more over a period of a couple of 4 to 6 months. It's going to have an effect, and we'll probably see how much of an effect we're going to hear over the next once January gets going. But as far as the Santa Claus rally goes, you do see there are funds, retirement plans and stuff coming in. You're going to see some swapping of securities. One of the bad things is you don't want to see a lot of portfolio managers buying these big cap tech stocks right now, because they'll look like an idiot when the end of the year portfolio statements come out. So that, because of the overweight of some of those stocks, you may not get as much of a bounce as you would. But let's say that maybe we end up with a little bit of a bounce or kind of a flat week. I would expect to see things kind of deteriorate a little bit further in once we start the new year. And what I would do is I would keep my cash in here, right, just for the next couple of weeks. Maybe towards the third or fourth week we can see how what's going on with the rates, and see if maybe we can start to nibble away at some of these other sectors. What we'll try to do in the next 2 or 3 weeks is just see how what sectors are actually starting to perform. We'll go over the Sam Stovall's sector analysis plan, where he talks about once you start getting the rate cuts coming in, or once the economy has slowed and we're trying to get it to pick up again, what sectors will lead the stock market out of the dumps, where we can start to nibble away on some things. So right now, I just be cautious. If you've got some things that you want to, I'm not sure I'd be a nibbler on stocks. If we do get a little bit of a bounce here, I would basically wait until after the first of the year, and let's see. I think we'll probably get a better chance to buy some of these, buy some positions.
All right. Well, that's all we have for you this week. Remember, if you have a question you'd like answered in the next Tuesday Tech Talk, email it into support@marketedge.com, or ask one of our live chat representatives to pass your question along to us for the next Tuesday Tech Talk. Thank you for tuning in, and we'll see you next week.